So good afternoon to everyone, and thank you so much for being here. And it's good to see so much of crowd for a conference which is all to do with alternates. I remember 10 years back when we used to talk to the distribution fraternity, acceptance of alternates, PMS AIF used to be very, very low. But thanks to efforts by platforms like PMS Bazaar, I think the acceptability of alternates is really picking up. So thank you all for accepting this asset class also. Like to start with congratulating the PMS Bazaar team for this seventh successful conference. I think it helps all of us meet each other and understand our views and get to know all of you. So congrats to them. Today we have this, we have all the experts out here, and we're going to talk about a very hot topic, which is talked about almost now over 12 months. We're going to talk a lot more on small caps and mid caps. And we all know that over the last 3 years, small caps and mid caps have delivered some staggering returns, right? So between 2001 and 2004, the best performing returns have come from funds which have been dedicated towards small cap, followed by mid caps, and then large caps. While in isolation, all the three market cap buckets have done well. So the Nifty 50 has also done well, over 20%. Mid caps have done over 30-35%, and small caps have done over 40-45%. But the rising question now is that going forward, given the kind of returns we have seen in the last 3 years, going forward, what should one do in terms of allocations between large, mid, and small? Right, so the whole debate about valuations and the growth opportunity, and a lot has happened this year. We've been behind the general election. We have now seen the US elections are also behind us. We've seen a lot of FII selling. We have seen the budget. So a lot of events have happened in the last 6 months. As we speak, there are 2 wars which are ongoing, and all of this has now eventually led to our markets also correct by about 10-12%. But despite that, interestingly, I was speaking with all the panelists last month, in the month of October, while we are all talking about safety net in large caps, but actually mid caps and small caps have outperformed large caps in the drawdowns also. So I think this space continues to be very, very interesting. And I think on the backdrop of very high economic growth and likely the economy to double in the next 5 years, I think the mid cap, small cap space is going to be very, very important, relevant. And I think that in today's atmosphere or environment, it's not going to be very easy to make money in the markets, right? It's going to be very, very stock specific, and I think now the real role of the fund managers and their skills to produce alpha in a volatile market, or if at all markets correct, how do you perform and how do you perform well? I think that will be something very interesting to see. So I'll probably now move into the panel, and I'll begin my first question with a very, very generic question. Let's hear from all of them, their thoughts, their views on small caps and mid caps. What have they experienced in the past, right? And what do you see where we are today? And what will be your outlook, which investors and distributors should know when they're looking at mid caps and small caps for allocation? So individually, if you can share your views, maybe that will help audience understand this segment much better from fundamental perspective. And maybe we can go right to left. So we can start with old friend Anil. So over to you, sir.
Yeah, thank you. I guess this is a time when all investors have been, set their expectations at a crazy level, right? So, and markets have spoiled us with the 30% plus type of returns, etc. in this period. And I think this time in the last maybe few months, couple of months, maybe we have a little bit of a correction, and people then coming back and saying, oh, you know what, is this going to last? And there's a whole lot of noise around, will mid and small caps do well? Is it over for them? And stuff like that. Personally, I'm a person of market cycles, and I believe that, you'll always find there are periods when large caps do well, there are periods when mid caps do well. And however, especially when you come back to mid and small caps, beyond a point, I think the index in some form, at least for us, is not the benchmark, right? When you're doing bottoms up, grounds up, okay, the point that we look at is, do we think, or do we see visibility of earnings growth in the companies that we are investing in, okay? And my view at this point of time, we have not yet seeing real issues in terms of, having that visibility. And of course, I'm not sure the 30% plus returns will sustain, but definitely visibility in terms of saying that, do we think earnings will grow at least 20% plus for the small caps and maybe 18% plus for the mid caps? And I think that is something that we are looking at, and we believe that, in the end, the returns of the portfolio is what your individual contributors are, right? So how you are able to ensure that at each stock level, you are giving that attention to ensure that, that each of the stocks are able to achieve that type of earnings growth. And definitely, so we are not seeing too much of a concern around mid and small caps right now.
Maybe you can also address the question of how you've seen the earnings growth trajectory for the last 2 quarters. And there's a lot of discussion that there should be recovery in the earnings growth, especially we'll stick to the mid and the small. So how is the earnings growth delivered for the first 2 quarters in this space? And what is the likelihood for next 2 quarters?
Yeah, see, the good thing is, in the last move, everything went up. It's like, if you saw the PSU pack, right? All PSUs went up, whether they are of good quality or not, right? So, and suddenly now you'll say, okay, something like a BEL is at a completely different level versus many of the others, right? So I think that's, what is important. And so a lot of noise was there, a lot of momentum was there. So coming back to our view that at least even at this point of time, even seeing a little bit of a slowdown in certain areas, we are not yet concerned, right? But at the same time, I think it is a bit of a red flag, whether we like it or not. And I'm just saying, just the GST collections coming down and stuff like that are points for us to think about and say, is there something which is, so other risks around the corner. But at least at this point of time, I think even if we are looking at it, despite, the last 2 quarters, and for our companies, actually, we are not seeing that slowdown. Okay, we are not seeing that change happening in the last quarter.
That's interesting. That's what I said, that now the fund managers are going to play a very important role. So, markets may be flat in terms of growth, but individually the stocks could be very different. So coming to you, Balaji, what's your sense?
Akhil, when we are talking about mid caps and small caps, we need to just take a step back and kind of speak about what is happening to large caps. So if you are able to sense what is happening in the large caps, you'll get a clear picture of what's happening in the mid and small. I've spoken about this in various forums also. In my humble opinion, the actual large caps in this country today are companies like Apple, Amazon, Alphabet, Microsoft. I mean, these companies today exhibit turnover. Their Indian operations, the turnover is today greater than Cipla, Sun Pharma, Bajaj, and all these Nifty 50 components. That is a fact of the matter, and they are growing very fast. Today, the large cap growth in this country, it's coming outside the Nifty 50. Whereas the mid and small cap growth is coming from within the market. So you have 15% of the Nifty weight in IT sector, and that is getting disrupted by GCC. You have 15% of weight in the Nifty in the consumer sector. For a 50,000 crore aggregate PAT, they command a 25 lakh crore of market cap, which is huge from a starting point valuation. So today, in the early part of 2000s, you did not have tax compliance, you had corporate governance issues in the mid and small caps, you still had a lot of unorganized. Therefore, you could be present in the top 30 companies in India and create a lot of wealth because your two-wheeler penetration was nothing great, four-wheeler penetration was nothing great. We were still underbanked as a population. But today in 2024, even India 3 has a two-wheeler. Urban penetration of four-wheelers is quite high, and most of the population is banked. So what was once fragmented, so paint used to be a oligopoly, so today it's an 8-player market. A two-wheeler used to be a 3-player market, today it's probably a 15-player market. So this disruption is making the large caps underperform, and this is why I feel that mid and small, though they are volatile and illiquid, they will continue to kind of create wealth over the medium to long term.
Sure, sure. Yes. What's your sense on mid and small?
So we've been small cap investors all through our journey. In fact, you mentioned that it's only the last 3 years that small caps have done well. Despite all market cycles and otherwise, for the last 12 years, investing only in small caps, we've delivered close to about 32% compounded returns. So our experience has been that irrespective of the market cycles, yes, we do go through volatilities and everything else. And like Anil mentioned, I think the core focus has to be on the growth and the valuation. Small cap cannot be looked upon as investing in the indices and taking the broader market perspective. It's always the stock specifics that one needs to get into and look at ground up and catch businesses where you can see growth and get in at a reasonable valuations, and that's what ensures wealth creation irrespective of the market cycles.
Yeah.
So I think there is still much more to happen. I agree to what Balaji is saying. Across manufacturing and otherwise, you will see a lot of growth opportunities over there, where small caps are actually disrupting.
Right. Right. So just want to just have a follow-on question. While we call mid cap, small cap, so when we talk about small cap, generally the perception is these are small companies, these are weak businesses, these are fragile businesses. Small is a very negative connotation, right? So I've read some research reports, and what we have seen over the last 10 years is that the definition of large, mid, and small itself has changed. So what are your thoughts about, is small really small in today's context, or it's changed? I mean, the definition itself has changed, the market cap buckets.
You are right. It's actually very funny that SEBI classifies top 100 companies as a large cap, next 150 as a mid cap, and rest everything else is small cap. So when you talk of small cap, that itself has multiple layers into it. I mean, so the top 251st company has a market cap of close to about 70,000 crores. Now, that's not small cap by any stretch of imagination.
I think the 500th company is 11,500 crores.
Correct. So from our perspective, the genre in which we look to invest is companies in the market cap range of 500 crores to 5,000. And that's what we call as a real small cap, even today from Indian perspective. And everything else above is larger small cap and larger small cap and mid caps.
So in your portfolios, do you have something below small cap?
Not really. I don't think that we get below 500 or 200 crore market cap.
Okay, okay, thanks. Vipul bhai, your thoughts on small? I think they have made some interesting points. Anything else you think?
Two things are to be kept in mind while investing in mid-cap and small-cap space. The first thing here in the current context is that we have to avoid recency bias. So what has happened in the last 2-3 years, that is not sustainable in the longer term. So that has to be set return expectation. The second thing is we should be very clear about our investing horizon. So if we need the money back in 6 months, probably we should not be investing it in equities, forget about small caps. So if once this context is set, then we are very excited about this space of small caps and mid caps. And the point is that right now, if you see on a trailing 12 months basis, small caps and mid caps, one must acknowledge that these indices are looking stretched on PE multiples, especially versus history versus large cap indices, right? But then the question is, why would you invest in indices, small caps and mid caps, if you have to invest in indices? You'd rather invest in small caps to generate alpha. You have to be a stock picker. So you have to pick your names and then you have to invest. You don't invest in index. So that's why this question of index getting expensive probably is not very relevant right now. One more thing that is worth mentioning here, that right now when you are comparing, let's say, small cap index multiples to large cap index multiples, the earnings growth also has to be kept in mind. I mean, in Nifty 50, probably we are close to zero kind of growth. In small caps and mid caps, we are still above 20, right? In our portfolio, in Magad Capital Future Stars, the small caps are doing more than 30% even now.
Yeah, I think that's an interesting point to note. I mean, they are still seeing 30% plus kind of earnings growth we're talking about, right? So eventually, I think as fund managers, they all believe that eventually the share price actually will correlate with what the earnings do. So that is more important to watch. And maybe these stocks would have corrected despite the earnings growth coming in.
Yeah, to some extent, some of them.
Yeah. Right.
So
sorry, continue.
Yeah. So I was saying that two big changes that have happened in the last 2 years when we compare small caps to large caps. So even though India liberalized in 1991, for the first 10-15 years after liberalization, credit access was still very limited. So for a small company in 2005, it was not very easy to get access to credit. That thing has changed dramatically, and that's why the playing field has been leveled in that extent. So large cap versus a small cap, big company versus a small company, that big change has happened. And secondly, in the last 10-15 years, the logistics systems in India have improved beyond recognition. So if you see the cost of freight, the cost of demurrage, port charges, all things, these things have declined substantially. So for a large company, probably a hit of 3, 4, 5 percentage points on their margin was absorbable. So in those days, 15 years ago, a small company would not stand a chance. Now, everyone has that level playing field. So that's why it's more interesting that more and more companies are emerging as challengers. And that's why you have more picks to make in small cap and mid cap space. Only a couple of things that you have to keep in mind while investing here. One, we need to be sure what are we investing in. So the research has to be impeccable because of lack of information for these stocks. And the second thing is, we must be in control of our emotions.
Yeah, absolutely. So how do we conclude this? What should one do? Remain invested in small caps? How much small cap should be there? Should you come lump sum or should you stagger out? I think in one line, if all of you can just kind of conclude this question and move it out of the table, right? So definitely from long term, smalls and the mids look good. But if somebody has a corpus today, what should one do? Go in or stagger? Given the fact that in last 2 months, a lot of good companies have corrected, maybe 10, maybe 20, maybe 30%. So as fund managers, are you finding, if you get cash, are you finding opportunities or you will be in cash and wait for some more time?
We are fully invested. For us, we have to ask 2 questions to ourselves before coming up with a response here. One, what is my time horizon? If it is more than 2 years, then I'm investing in small caps. Second, how much of volatility can I absorb at least on a notional basis? So for example, if I invest today, tomorrow if the portfolio goes down from 100 to 90, am I okay with that? If no, I should not be in equities. If yes, then I should be in small caps. So for me, up to 75%, I would be okay to invest if my answer is yes to these 2 questions. 75% I'm saying I would be okay to invest in small caps and mid caps.
Pawan, quickly, what do you do?
Well, we are 100% small cap investors. And small cap investing has to be done best in a staggered manner, irrespective of the market conditions. I mean, right now we are going through a correction mode. Even if it were a bull market, I think one needs to step back because by nature, small cap tends to be volatile and one needs to understand that. And if you play the volatility to your advantage, you are sure to create wealth in the long run. So despite having, the earnings growth at 30% or 25% and all of those kind of things, we are still, I would say, cautious because the volatility will play out. So if you have 100 rupees, maybe it will just work, stagger it over the next couple of months and play it out that way.
Sure. Balaji?
Yeah, Akhil. So, asset allocation is not our expertise. So we have invested to the tune of 95%. The client who comes to us has already done his or her asset allocation and given the money to me. Therefore, my job is to navigate within the market circumstances. I'm not trying to play cute by having a huge cash, trying to predict uncontrollables. I don't know about Trump and Russia, Ukraine and nuclear war and so on and so forth. So I cannot be sitting on cash and, wasting available opportunities. If something appears to be overpriced, you can always sell and move into a different idea. And that is what we continue to do and we will continue to do.
Sure. Anil?
Yeah, so interestingly, actually, we opened up a small cap fund which we closed for subscription, in this fall.
Okay.
And of course, we were suggesting that, it can come in a phased manner so as to sort of manage risk, because for us, risk is also a very important one. And we continue with our, mid and small cap. Interestingly, there, we have probably 70% plus in small caps, because we find relative to mid caps, I think that's where the value is, and I think the way the SEBI definition is as well, right? The small caps is not necessarily small cap in our view, which is why we have it that way. So I think at this point of time, it's a good time from an investor standpoint to also continue to put in money, maybe do it a little bit phased if at all one wants to manage risk. But considering that market has come down, it's not a bad time to also infuse money.
Yeah, and I think all of you can also keep one thing in mind, that the mutual fund SIP flow of almost 25,000 crores, I think almost 2/3 of the SIP flows on a monthly basis goes into small caps and mid caps, right? So a lot of liquidity also comes in this market cap bucket. So one, I think what we really understand from this, the first question is that small caps and mid caps are here to stay. 3 to 5 year, I think there is a huge potential to outperform the large caps. The definition of large cap, mid cap, small cap itself has changed dramatically over the last 10 odd years. Lot of opportunities in this space, and stocks are fairly liquid for managers to comfortably buy and create positions, right? So I hope you get your answers on what should one do when you're trying to allocate your capital or your investors' capital into mid caps and small caps. So I think keeping that question on the side now, I think we'll get more specific now to understand your own philosophy, your own investment frameworks, your experience of managing clients' money over time. How do you actually create your portfolio, whether it's more top down, bottom up, top down. So let's try and understand your individual style of investing. I think that will help audience decide how they should consider your portfolios from allocation perspective. So maybe Vipul bhai, you can start.
So ours is a relatively conventional style of investment. We mix up fundamental style of research with behavioral finance. So we are less active, although we are not afraid of taking calls, obviously. And at a fundamental level, our process is tethered to figuring out what the fair value of a stock is. So whatever we do in terms of understanding the company, in terms of understanding the business model, creating an earnings model so that we are able to forecast the company's numbers. And we try to forecast it as far out into the future as we are able to do. And after that, we try to figure out what the fair value is. We rely on discounted cash flow model for our valuation, but we also look at the multiples PE, PBV, and EV to EBITDA. And then we flex the assumptions. We try to look at various scenarios. We try to assign probabilities. So on that basis, we come to a weighted average fair value for the stock. And then we try to see what is the gap between the stock price and the fair value. So beyond that, everything else is noise for us. So that's the first step in the fundamental part for us. The second part is the portfolio construction. So we have devised a way of portfolio construction, which we call as FACTS box. So it's an sort of acronym for FACTS. These are the 5 letters. We have divided our portfolios in 5 different baskets. So F stands for fast grower companies, A for asset play companies, C for cyclical companies, T for turnarounds, and S for stalwarts. So these all have very different traits from each other. And for a company to be finally considered for inclusion into our portfolio, it has to fit into one of these baskets. And these baskets, we have assigned different ranges. All the 5 have different ranges of allocation. So it can't, for example, fast grower, in case of the multi-cap approach that we run, value for growth, it shouldn't be more than 45%. It should be less than 30% of the portfolio. So it has to fit into any stock. For it to be considered here, it has to fit into this. So that's how we are able to do a proper real diversification rather than just doing a certain number of stocks, a certain number of sectors and all. And after taking this decision, okay, this stock is looking good, let's buy it, we subject it to the behavioral finance framework that we have devised. So we have a checklist based on our experience, checklist of common cognitive biases. Basically, we want to keep aside every iota of emotion that can come into our decision. We want to be rational in our decision making so that we are able to reduce the number of mistakes, and especially those mistakes that can wipe us out. So we have some tools that we use, what can go wrong, or a pre-mortem analysis. So all those things help us in arriving at the correct decision. So yeah, that's the process that we follow.
Great. Pawan?
So we are more like business investors. So we look at investing in a very, very ground-up manner where we take the private equity approach to investing into this small cap categories. And what it essentially means is getting into businesses really early on, much before the larger market starts to take a note of it. But what it requires is very, very deep understanding of the businesses that we invest in and do a deep due diligence before you get there. I think the biggest risk in small cap investing is, getting the promoter right. And that's what we lay a lot of emphasis on to make sure that the promoters that we are investing into have the right vision, transparency, corporate governance issues are right up there. And that's what ensures long-term value creation. So last 12 years, we've devised our internal framework for our due diligence to understand these businesses. And we restrict to investing only in areas where we feel we have the wherewithal to do a deep dive due diligence. Otherwise, we are better off to let go opportunities in segments which we don't really understand. The idea is that if the businesses that we are investing into, if they can grow at a compounded 25% growth rate, and if we are able to hold on to the business for maybe 5, 7, 10 years, the portfolio returns have to come from the underlying growth of these businesses. So if I have a business which can deliver this 20, 25% compounding for 10 years in terms of operating profit growth, I'm reasonably sure of the portfolio returns. And because we are early investors, generally the valuations tend to be very, very reasonable. So if a re-rating happens on the stock, that's just icing on the cake.
Right.
That's what we look to do.
How's your, how active are you in your portfolios? Because you have a peak style kind of looking at companies. So is it a very high churn portfolio, or you are like, you give 2-3 years time frame, buy and hold?
It's a very low churn portfolio. So like I said, if we end up buying a business which can have the promise to grow at 25%, there is no reason for me to churn the portfolio.
Sure.
For as long as the valuations continue. What we instead look for is the ability of the business to generate free cash flows, which can be redeployed to ensure that the growth continues. If a business is good enough to generate cash and it's not dependent on external capital, that ensures that consistency of growth.
Sure, good. Balaji?
So our style is that, if you look at the Nifty 50, the index fund, it has given about 11%, 12% CAGR over the last 10 years. So nominal GDP growth of this country is around 11, 12%. So if you want nominal GDP growth in your portfolio, all one needs to do is to buy the Nifty 50 index fund. So everyone wants greater than nominal GDP growth. So the starting point is we look for industries and companies that are growing at least 1.5 to 2x the nominal GDP growth of the country. So when you say that the country is growing at 11%, there are certain industries which grow above 11, there are certain industries which grow below 11, and there are reasons for it. Primarily, there are two reasons. First reason is it could either be a cyclical reason where the demand has overshot the supply, prices have gone up, therefore industry X is growing greater than the nominal GDP growth of the country. The second reason is more a secular reason where the consumer buying behavior of a product and service has undergone a change because the Indian has slowly started getting richer. Therefore, the products that he or she was consuming 10 years back, he is probably not consuming that now and he's moved on to something else. So we look for those migration in those type of things, like for example, plywood to MDF, regular dairy to value-added dairy. In automobiles, we have seen hatchback to SUVs. So the consumer buying behavior 15 years back and now, if you go to an auto showroom, 15 years back, it was kitna deti hai. Now it is like whether the car has ADAS and airbags and sunroof and so on and so forth. So tracking this, according to us, gives us wealth creation opportunities. And in terms of portfolio construction, we are slightly diversified. We are very happy with a 35 plus kind of holding. So we don't want to concentrate too much and say that we can create alpha within 15, 20 names. So we start off small and then the conviction builds up over a period of time during which we ramp up the weightage of the stock in the portfolio.
Any top weights? I mean, let's say 7%, 8% cap, 10% cap, or where you start to do your profit booking, or?
At cost, we look at about 7-8% in terms of top weight. And then there have been instances where it's crossed, say 13, 14, 15%. We start pruning it down and bringing it back to sub 10%.
Perfect. Anil sir?
Yes, so our whole investment philosophy is broken up into two parts. Okay, one of it is about how can we deliver risk-adjusted return, right? So risk is a very, very important part of what we do. And the second part is process, right? Risk-adjusted return for us, in our view, should also be demonstrated in numbers, right? So what happened, let's say, when this market fall was there? Did you fall lesser? And we are happy to say that yes, most of the time that's how it has been, right, including this time. Similarly, if you are able to look at it in terms of measures, right, of risk-adjusted measures, and those again are aspects to that you can measure. So our point is, philosophy is useless if it's not there in numbers, right? The second part of it is about, process. So process is basically something very much ingrained in me because I worked in Wipro. Okay, so there are say 4 parts that we've broken up the whole investing journey into, right from the screening side. Then we have a more deeper evaluation. Of course, within that we do a ranking of companies which come into our screen, and then we go deeper into looking at maybe what are the potential of this particular company, which come within that screen. The third is about a risk process, and that is something that even before we enter into a stock, we do a limited forensic, and on a continuing basis also we track parameters on whether they are deteriorating. And the last is about valuations, because our view is valuations also is an important part of the overall, because it is one which will also impact the risk. But if you get it at a better valuation, then you probably have a lot more runway to go. Of course, like I said, process is very core to what I do. So we even made a process out of, for mid and small caps, a multi-bagger process. Okay, so the thing was, sometime, we saw a few stocks which were multi-baggers, and I said, how do I make this also a process? Okay, and what was interesting is, in the last 3 to 5 years, we have almost now 25 stocks that we actually have as multi-baggers across maybe a couple of, because we also have flexi cap and mid cap and small cap. So that is the type of thing that we have seen. So, and the view is, if you do it bottoms up, if your individual stock, you give it the attention that it deserves, if you're disciplined in your investment and your process, I think discipline helps you deliver consistent returns. And the deeper you go, then, you're able to get that alpha.
Absolutely, and let me tell you, I've been through the portfolios and performance of all of them. I think they've done phenomenally well. I think on a 1 month, 3 month in a corrective market, the outperformance has been anywhere between 3 and 5%. I think that's the first thing. When markets are down, how do we do? And even on a longer term basis, if you track their performance 1 year, 3 years since inception, I think a very healthy alpha. So congratulations to all of you and your processes. I think we just have now 1 minute 30 seconds, so we can do probably a quick rapid fire kind of session. Maybe very quickly, if you look at all your portfolios, what are your 2, 3 top sectoral allocations? And maybe if you want to share about 1 or 2 top ideas, I think everybody will be very keen to understand that. Very quickly, we have 1 minute 12 seconds, right? So maybe 30 seconds each.
For us, consumer-related themes and manufacturing-related themes. These are the 2 biggest sectoral themes where we have allocation. In terms of names, we like PG Electroplast and Zomato quite a lot, although Zomato has become a large cap now.
Chalo, great. I think one of you they were telling me in the break that a couple of months back, people used to give tips to them. Now people are asking tips, right? So it's no longer that easy. Yes, sir.
So for us, it's the manufacturing theme. I think what we are playing is the whole import substitution and the export opportunity which is coming up for Indian manufacturing, thanks to Europe +1 particularly, more than the China +1. Infrastructure plays is another segment that we very keenly look at.
Balaji?
So we like the furniture theme. So we like the plywood to MDF story.
That's
so
good.
Asia's second largest listed MDF player is available at about less than $500 million market cap. And there have been some short-term pain in the company due to various issues. But I think over the next 2 years, this sector is expected to show tremendous growth. The second opportunity is testing. So everything in India is going to get tested. So whether it is food, pharma products, fruits, vegetables, electronics. So testing as an industry can grow greater than 1.5 to 2x the GDP growth. So the stock here we are referring to is 𝐵IMTA Labs, basically.
Okay, great.
Yeah, so I think India is reasonably a consumer-oriented market, and because just if you look at the per capita, growth. So if you see that itself, as time goes by, if you look at other economies, you will get higher up in the chain there. So consumer discretionary definitely. Then within that, smaller themes like jewelry, we've liked building materials, manufacturing is another one, I think, which will sort of do well. So broadly, these are the maybe 3, 4.
I think the consensus, the common consensus, if you see all managers, I think consumption is definitely, there's a consensus on high conviction bet on consumer, especially consumer discretionary. And then I think manufacturing has been a common theme, but apart from that, I think the furniture business, the second one you spoke was? The testing side. So, this is the beauty about small and mid. You get so many opportunities in very differentiated kind of business. Nobody talked about financials. Nobody spoke about banks right now, right? So, I mean, a couple of years back, banks and financial used to be the first sector, first theme anybody used to talk about. So, great. I think the time is up. Thank you so much, all of you, for sharing all your thoughts, and, request you should look at their portfolios and also look at Motilal Oswal portfolio. Today I couldn't talk about my fund, so look at us also. So thank you once again, and it was lovely meeting all of you, and best wishes. Thank you so much.